Welcome everyone to today's video on S corporations. This is our first video in the S-Corp series, where throughout the series, I'll go over the life cycle of an S-Corp from incorporation to running the business in the most advantageous and tax efficient way to ultimately closing down the corporation either by way of sale or liquidation. In this video, we will start off with the S-Corp fundamentals, so let's get started. So a bit about me. I'm Daniel Rohr, and I have been the managing shareholder of Rohr Associates. It's a CPA firm based in California since 2012. I am a CPA, a personal financial specialist, and enrolled agent. I have a master's in taxation from Golden Gate University. I specialize in advanced tax planning, estate planning, and business consulting. My practice maintains a large clientele of S corporations where we guide them in tax planning and tax compliance issues. Our agenda for today is to start with defining what an S-Corp is, who can be a shareholder of an S corporation. We'll talk briefly on the legal protection that the S-Corp provides, and then we will go into how to set up an S corporation and transferring an existing business to an S corporation. So let's start with, what is an S-Corp? An S corporation, or S-Corp, it stands as a distinct corporate structure that strategically combines the legal protection of a traditional corporation with the favorable taxation benefits of being a flow-through entity like how a partnership is taxed. However, an S-Corp has some unique tax treatments that we will explore in detail throughout our S-Corporation video series. This hybrid model provides what is known as a limited liability protection. It shields shareholders' personal assets from the corporation's obligations and debts. This level of protection is what you would find in a standard corporation. But what truly sets an S-Corp apart is its tax features. And unlike traditional C corporations that face taxation at both the corporate and individual levels, an S-Corp allows profits and losses to flow directly to the shareholders' individual income tax returns, resulting in one level of tax, rather than the double tax issue of C Corps. You get this tax flow through benefit by being a partnership, or if you only have one owner, you can get it through a single member LLC, and the same legal benefits of the S corporation by doing so. What truly sets the S Corp apart, though, is that none of the flow-through income is subject to Social Security or Medicare taxes. This is known as FICA tax. And with a partnership or single member LLC, where I said you get the legal protection similar to the S-Corp, the taxation of a partnership or single member LLC, that income earned by active partners or the owner of the single member LLC, the entirety of it is subject to FICA, which is 12.4% for the Social Security portion, up to the Social Security wage base, which for 2023, that number is $160,200. So 12.4% on all your income up to $160,200. The Medicare tax portion is 2.9%, and that applies on all income, but there's no limit. So from just being a S corporation, you save that 12.4 plus the 2.9% on most of your income. Of course, if you're over the wage limit, then you would not have to pay Social Security on amounts above that. But you can see where that can be pretty valuable in being an S corporation just for those tax benefits alone. Now let's look to the eligible shareholders. So not everyone can get the benefit of being an S corp. And it's essential that if you're considering this business structure, that you understand these. First, there's a limit to the number of shareholders, and it's capped at 100. This restriction helps maintain the more personalized nature of an S-Corp. It's designed to suit small to mid-sized businesses. And second, all shareholders must be U.S. citizens or resident aliens. This requirement ensures alignment with U.S. tax law, a fundamental aspect given the S-Corp's unique pass-through taxation mechanism. And additionally, certain entities are explicitly not eligible to be shareholders. It includes other corporations, partnerships, and non-qualifying trusts. The specific trusts that do qualify, though, are grantor trusts, like living trusts, qualified subchapter S trust, and electing small business trust, they can be shareholders of an S-Corp. Also noteworthy is that the family attribution rule, where members of a family can be treated as a single shareholder for the 100 shareholder limit. This provides added flexibility for family-owned businesses. Now let's move on to legal protection. One of the substantial benefits of an S-Corp is the legal protection. And this limited liability feature ensures that the shareholders' personal assets, such as their homes, cars, and personal savings, are generally safeguarded from the corporation's debts and liabilities. However, it's vital to recognize this protection is not automatic. It doesn't just happen because you're an S-Corp. The integrity of this legal shield hinges on maintaining proper corporate formality. This includes holding regular meetings with shareholders and directors, keeping accurate corporate minutes, adhering to state compliance regulations like filing your statement of information if you're in California, and importantly, keeping your business assets separate from your personal assets. It's a common issue when taxpayers will use corporate funds for personal use, like paying for personal travel or paying for their mortgage on their residence. Neglecting these formalities can lead to what's known as piercing the corporate veil. This is where courts may hold shareholders personally responsible for the corporation's debts. So it's important to make sure that if you want to use the profits from your S-Corp for personal expenses, you do so by transferring the money from the corporate account to your personal account first. So let's move on to how to set up an S-Corp. Setting up an S-Corp involves a deliberate and methodical process, and it's recommended that you use a legal professional to help with the process. So the first thing to do is to choose a business name. The initial step involves more than just creativity and figuring out a business name that you like. You must ensure the name complies with state regulations, it's not already in use, and it may require fictitious business name filing if it's different from the legal entity name. The second thing you need to do is file articles of incorporation. This step establishes the legal framework of your corporation. It includes details like the number of shares, the purpose of the corporation, and the registered agent. Each state may have different requirements, and proper filing is essential. Third, you need to obtain an EIN, which is an employer identification number. This is vital for tax purposes, and it's required for hiring employees. It's your business's unique identification number with the IRS. It's like the business's social security number. And you'll also need this to open up the corporate bank account. Then you need to adopt bylaws, and the bylaws, they detail the rules and structure of your corporation. They outline the roles of the officers and directors, the meeting procedures, and more. These are crucial for maintaining proper governance. Finally, you need to file Form 2553. This step involves electing the S-Corp status with the IRS. So the previous steps, you've basically become a C-Corp. Now you're telling the IRS, I'd like to be taxed as an S-Corp. And the way you do that is by filing Form 2553. And this step must be completed within 75 days after incorporation. Here's an example of a completed 2553, and it's for a married individual in a community property state. I'm in California, and this is how we have to do 2553s when there's a married individual electing to be an S-Corp. As you can see on the second page, the spouse of the shareholder, even though they don't have directly any shares, they must sign the 2553 agreeing to the S election. This is pretty important, and I see this missed more often. So it's important that you make sure that you have this type of wording on your 2553 if you are married and live in a community property state. Now, what happens if you fail to file the 2553 within 75 days? You can still file a late form under Revenue Procedure 2013-30. To be eligible to use Rev Proc 2013-30, the entity must have acted reasonably and in good faith, and the failure to file must not have been the result of willful neglect. And the entity and its shareholders must have been taxed as if the election had been made for the time the election should be effective, meaning you would have filed the 1120S, which is the S-Corp return, file your tax returns, your individual returns, as if you are an S-Corp shareholder. that is important, and it's imperative to be able to utilize the revenue procedure to be able to have a late 2553 allowed. And you have 3 years and 75 days following the date the election was originally required to be made. The way to file the 2553 with the election is to add the verbiage you see at the top of the 2553 where it says filed pursuant to Rev Proc 2013-30. And you must include a statement for the reason the 2553 was not made timely, which you can see in the highlighted example. If you're filing the election with an initial 1120S, so as an example, if you incorporate at the beginning of the year, January 1st of 2022, you're not going to file that tax return until March of 2023. And so your 2553, if it wasn't filed prior, would need to be filed with that initial tax return, and it would be considered late. So the way to go ahead and do that is you file it as you see on the screen for the actual verbiage of the 2553, but then you also need to include that statement that says includes late filing election pursuant to Revenue Procedure 2013-30. All right, so now if you're transferring a business to an S corporation, it's already existing, you're running it, maybe it's a sole proprietorship, and you want to become an S corporation. How does that work? You get to utilize Code Section 351. So it's a common thing to do where you already are a business and now you want to incorporate. Code Section 351 permits a tax-free exchange when you're moving the assets of the original business into the corporation. You need to make sure that you stick to the 351 code section requirements. It's essential. Otherwise, what's happening is that effectively what you're doing is you're selling the assets to the corporation for fair market value. So if you had equipment valued at $10,000 and you've depreciated it down to zero, and you're incorporating a business, so you're moving it into the business and you're receiving stock for a value of $10,000 because you've moved $10,000 worth of equipment into the corporation. Without Code Section 351, you're going to have to pay tax on that $10,000 deemed sale. It's a bad result. So making sure that you utilize 351 is pretty important. And Section 351 is actually pretty complex. Its application, it's beyond the scope of this video to dive deep into the intricacies of the law. But the important takeaway is that it is available, and it's highly recommended that you work with a qualified tax professional. But briefly, the essential condition is that the transferors must control at least 80% of the corporation's voting stock immediately after the exchange. This includes both voting and non-voting shares. The transfer process, it involves careful planning, legal documentation, valuation, adherence to the 80% control requirement, and proper reporting to the IRS. A 351 statement needs to be filed and attached with the corporate return and the shareholders return. So to quickly recap today's video, we went over what an S corporation is, where it fuses the legal safeguarding found in standard corporations with unique tax features that prevent double taxation while exempting income from FICA tax. We went over eligible shareholders. The key eligibility criteria include a cap of 100 shareholders, U.S. citizenship or resident alien status, and the allowance of specific trusts like the grantor trust. For legal protection, safeguarding personal assets requires meticulous adherence to corporate formalities, and missteps can lead to the erosion of the legal shield and where you pierce the corporate veil. We talked about the process of setting up the S-Corp, which involves selecting a name, filing articles of incorporation, obtaining an EIN, adopting bylaws, and then electing the S-Corp status with Form 2553. We briefly discussed the late election is available using Rev Proc 2013-30. And we finally touched on transferring a business to a corporation using Code Section 351. Now, the decision to form or convert to an S-Corp is significant and involves some multifaceted legal and tax considerations. I hope this first video in our S-Corp series was informative and helpful. I strongly encourage you to seek the personalized guidance of a qualified CPA, tax professional, or legal counsel who understands your unique situation and can advise you accordingly. Thank you for watching.